Hi, Andrew Unknown here, mortgage agent for Rock Capital Investments. This is the second in my video series looking at the key aspects of the mortgage financing industry. Like I mentioned in my previous video, these are going out bi-weekly to both my contacts in the real estate industry and also on my YouTube channel, AR Known Mortgages. They are specifically designed for realtors to use for their clients so that they can explain the process to them, and then also for anyone who's interested in mortgages. If you are looking for a new home, or you're um, curious about the mortgage industry, this is the place where you can find all of this content. Now, this week we are going to be focusing on the second one of the key aspects, and in my opinion, the second most important aspect of your of buying a home, which is your debt servicing ratios and your total credit score, and all of your everything goes along with your credit. Now, in the case of the debt servicing ratios, there are two. The first is your gross debt servicing ratio, and the second is your total debt servicing ratio. Your gross debt servicing ratio focuses specifically on your housing costs. So that's your hydro bill, your heating, your the monthly mortgage payment, so principal plus interest mortgage payment, or just interest depending on what type of mortgage you have, but it's going to be your mortgage payment, and how much the house itself is going to cost. How much, and all of the things associated with the house. So that's your property taxes as well, like I mentioned, your heating costs, hydro, anything like that. Now, your total debt servicing ratio is how much debt you, as a borrower, or the borrower, will have. What this means is this includes any revolving credit card payments, any other loan payments like a student loan or a car payment, or any other sort of loans. For example, if you have a line of credit that has a standard amount you have to pay every month, that'll be included in that. And also any other, like I said, any other standard debts that you have, any other debts that you or the borrower will typically have. The ratios that are typically used for mortgages are 39% GDS and 44% TDS. What that means is 39% of your total debt, 39% of your income can go towards your housing costs, and 44% can go towards your total debt. So 44% of your income can be covered by debt, taken up by debt, basically debt repayment. Now, there are some exceptions to this rule. There are quite a few lenders that I, as a mortgage agent, have access to that do have what we call extended ratios, but I can get into those. I'm not going to get into the specifics right at this particular moment. The other thing I wanted to mention in this particular video is your credit score. Your credit score, your beacon score, what we call a beacon score, is typically one of the most important factors in determining the best rate that you have available. Rather than, for example, if you work with a financial institution on the A side, like a scheduled bank, or credit union, then they will typically have different rates that you can use. But again, depending on what your credit score is, they may have different products that you qualify for. They usually have qualifications for their best rates, and if you have the higher your credit score, the better your credit score, the lower rate you're most likely going to have out of the products that they offer. So credit scores range from, typically from about 400 as a low end to about 900 at the top end. The higher your credit score, the better it is. So the closer you can get to 900, the better. And some of the best ways to deal with that are to pay down debt before you start looking. So, for example, if you or one of your clients is looking to buy a home in, say, 6 months, then as much as they can, as long as they're still, obviously, hopefully saving for a down payment, as we talked about in the last video, but also, paying, for life, because obviously that's the thing that they need to do. But if they can start paying down their debts as quickly as possible before their mortgage application, they will increase their purchase power and the amount that they qualify for. The fewer debts you have, the more likely you are to qualify for a higher mortgage amount, regardless of what the rate is. And then the second best way to do that is, again, that we look at is debt consolidation. For example, using a loan to consolidate debt and pay off specific debts. So say, for example, you had um, an outstanding loan and you needed to pay it off. Some of the mortgage aspects can pay off certain types of debt. For example, some CRA debts and and things like that as well, especially for small business owners. Those are an option as well. But again, like I said, those gross debt servicing ratios are typically key, and your total debt servicing ratio is probably the most key, because in most cases your GDS isn't going to stand out too much. Your GDS, as long as your as long as your property taxes aren't completely insane, and the depending on the size of the lot and the size of the home that you're purchasing, and your heating costs, things like that aren't going to be too crazy. So typically your GDS we can sort of play with it and fit it in that 39-37% range. Your TDS is the most important. Right, keeping your TDS low, keeping the total amount of debt that you or your client has, is keeping the total amount of debt that your client has low is one of the most crucial aspects of qualifying for a mortgage. And no, I understand that that's not exactly as easy as possible. So that's why most lenders have what they call guidelines for your credit scores. So what they will say is, for example, say somebody has a 600 beacon score, well, and then they qualify for this product, versus a 700 beacon score versus an 800, stuff like that. So again, those are the most important aspects of your mortgage some of the most important aspects of your mortgage application, because they affect how much you qualify for under a certain rate. For example, if you're buying a home and the home, or you or your clients are looking at homes and the homes are $650,000 and you need, say, a $500,000 mortgage, but because of your total debts you only qualify for $300,000, that might run into an issue. And it's why what we call pre-approvals or rate holds are so crucial in this industry, right? These can show you, okay, before you start if you're ready to start looking for a home, usually you can get a rate hold for 120 days, which in today's market is crucial because rates are constantly changing. But you can get a rate hold for 120 days, and we pull credit. We check in with all of the debts, and we run the numbers for you to make sure, hey, this is how much you qualify for. You do qualify for the amount that you're looking for. And it allows you to possibly, be more informed regarding your purchase power or your client's purchase power on a specific home. For example, if especially if you're going to go in firm on an offer, which is something I never recommend until until you have your financing done. But if, for example, say you're going to go in firm on a property that's worth $600,000, and you think, okay, well, I have $75,000 for the down payment, and I'm going to purchase a home, and I'm going to be able to qualify for the mortgage, but it comes back and your credit comes back poor, you may not be able to qualify for that amount, and things might need to change, and you may lose the home for no other reason other than your credit score or your debt servicing ratios don't fit. So it's imperative to make sure that those numbers are below whatever threshold that you need for the lender that you have that we are going to go with. And that's one of the things that we do as mortgage agents, is to make sure that yes, if your say your GDS is fine, is under the 39%, but your total debt servicing ratio, your TDS, is a little bit higher, it might there might be other products that we can look at, that certainly I have access to, that might allow you to be qualify for the extended ratios, depending on other factors as well. Anyway, just wanted to say thanks again for checking out these videos. If you're if you're watching on the YouTube video, then please, don't forget to like and subscribe for the realtor contacts that I've sent these out to. Thank you for listening thus far. And if you or any of your clients have any questions about mortgages, feel free to respond, email or call me at any time. I'm always available, even if it's a 5-minute conversation or what you might consider a dumb question. There are no such thing as dumb questions in the mortgage industry, and I'm always happy to assist and happy to help out in any way whatsoever. Anyway, thank you very much, as I said, and bye for now.